Sales Investment Director. And in this latest edition of our regular market review, Breaking the Mould, I'm going to look at what's going to cause the biggest fuss in the coming week. Now, the seasonal pickings are a bit thin on the corporate reporting front, but two statements could be worth a look, and they both come on Tuesday the 15th. They are a trading update from oil equipment and services player Petrofac, and interim figures from multimedia and silicon chip player Imagination Technologies. Keep an eye out for those, but the real fuss is surely going to come on Wednesday the 16th, when Janet Yellen, chair of the US Federal Reserve, will offer the American Central Bank's latest interest rate decision. That's where I'm going to focus, and even if you don't own any US stocks or funds, you probably need to know about this, given the influence American markets can sometimes wield over share prices on this side of the pond. Now, after a year's worth of frankly shilly-shallying, the US Federal Reserve is widely expected to increase interest rates in the US on the 16th of December. This will be the first increase of any kind in American headline borrowing costs since 2006, and the first turn in a rate cycle and a shift from easing to tightening since 2004. Now, the chart behind me here shows how the Fed funds rate has developed over the past 20 years. On the face of it, falling unemployment, improved wage growth, and the possibility of core inflation moving towards the Fed's 2% target are all good grounds for acting and increasing rates and tightening policy. However, remember, job figures are a lagging indicator. It takes time to feel confident enough to hire staff and then go through the complex process of doing so. Concurrent indicators like industrial production, retail sales, durable goods orders, well, they're mixed, as the year-on-year trends for all three in this graphic behind me illustrate. Lead indicators like manufacturing surveys also look spotty, although the local results from the Richmond, Philadelphia, Kansas and New York Feds have shown some cautious improvement this autumn, even if the new order readings are frankly still, well, pretty poor. So, what might Janet Yellen actually do? It's not a totally clear-cut call given the mixed US data and also the prospect that a rate hike could drive the dollar higher and crimp the competitiveness of US exports. So, Yellen could do nothing, though this may raise some serious questions about her and the Fed's credibility and prompt fears the US Central Bank may be acting too slowly, leading to inflation later on. She could go for the standard 1/4 or 0.25% rate hike. She could try to finesse the situation and go for a 1/8 of a point hike. Then there's also the issue of what guidance she gives, if any, for 2016 on whether the Fed will go for further hikes, assuming there is one, or not. It is, after all, a US presidential year, election year, and any and every move will be hotly debated in Washington, even if the Fed is politically independent and neutral. If I was forced to guess, I'll go for a small hike and then a fudged comment on 2016 to keep all options open, but with little or no ultimate action next year. Well, that's my guess anyway. I'm not sure that would be an ideal outcome for markets either, as it would leave uncertainty over both policy and economic growth, and as we all know, markets just don't like uncertainty. Regular viewers, and indeed readers of our weekly investment blog on the AJ Bell Youinvest website, may well have seen me use this chart before, but it's worth repeating it. It shows how America's S&P 500 index has performed on average across the 7 rate hike cycles seen since 1971, and it does so by looking at average index changes 12, 6 and 3 months before the first move, and then 3, 6, 12 and 24 months after the first rate hike. As you can see, on average, and I stress on average, the market does least well going into and coming out of the first hike. That's the dip in the middle of the chart. It then gathers momentum, assuming corporate earnings momentum is still okay and the underlying economy keeps on trucking. Now, the current picture on US earnings is frankly mixed. This chart shows research from Standard & Poor's, which illustrates year-on-year earnings per share growth by quarter since 2011 for America's S&P 500. Now, it's not pretty viewing. The final 5 columns show the consensus analyst estimate built bottom-up, starting with this quarter, the 4th one of this year. Let's hope they're right, because that's a pretty punchy-looking recovery after the recent slide, even if a lot of that drop has come from oil and resources stocks. And frankly, that big recovery may be needed to keep the S&P 500 going after a 7-year bull run, which is showing a little bit of tiredness. It's struggling to make progress. And, to repeat, even if you don't invest in US stocks, you do need to keep all of this in mind. Just look at how our own FTSE All share performs relative to America's S&P 500, where one goes, the other tends to follow. So like it or not, we all need to keep an eye on the Fed. So thank you for watching, and I look forward to seeing you next time.